One of the things 2020 might be remembered about is the profound disconnect between the financial markets and the economy. How long can we continue like this?
It troubles me a lot. And the answer is I really don't know. I mean, many of us have kind of thrown our hands in the air and said, well, equities are just a function of central bank printing now. I don't know, because it's also dangerous to make that assumption if you're wrong. Because, you know, this feels a lot like the 1930s as well, and equities fell 90%. I mean, don't forget, in Eastern Europe, whether it was Bulgaria or whether it was a whole number of countries, saw their equity markets fall 90%. We saw Cyprus fall 99%. So, I'm not sure. So I don't trust the signal. It makes me really nervous because, again, if we talk about an aging population, if people suddenly think, well, equity markets are the safe haven and they're not, well, that's a catastrophe.
Mm. How different are your investing activities today compared to your Goldman Sachs days?
Well, when I was at Goldman Sachs, I was writing about and talking to clients about these very issues then. The pension crisis, they were all coming, the debt crisis. So I've been following this narrative, and I switched my entire pension, all of my pensions from my days of working at investment banks, I switched them all into bonds in 1999, 2000, and I've never changed them back again. And it worked very well. Bonds have done very well, particularly, you know, I was living in Europe, so versus European equities, bonds were a phenomenal bet. So that hasn't changed. It's become more urgent now to think to the future as opposed to protecting what I thought was coming. We've now hit what I knew was coming. And now it's like, okay, what do we really do from here? So my asset allocation has changed dramatically. I also am much less interested in equity markets in developed countries for the reasons we talked about, but I'm starting to look forward into emerging markets and other areas of opportunities as well.
Mm-hmm. Assessing the risk in the money flooded market, how difficult is it?
Well, as we discussed, almost impossible. That's why, you know, I still like bonds because I don't think you can generate inflation, but there's not a lot of money to be made. Maybe in the US, they can go from 30-year bonds or 10-year bonds are at 85 basis points. Maybe they go to -20. Okay, that's a decent trade. It's not really an investment, you know? And that's the problem. And we'll come on to crypto and other stuff later, but that's a big problem.
What is the commodity market situation? Is it really going to take another 3 to 4 years after the recession for the prices to recover?
Yes, I think they're probably in a bottoming process, but for commodities to recover, the dollar has to really weaken. Now, the dollar's at the bottom end of the range. Maybe it breaks lower. I actually don't think it does. Normally, commodities bottom after the recession. So if I remember in 2000 recession, silver, for example, really started taking off in 2003. Oil started taking off then as well. They all bottomed beforehand, but they didn't start accelerating till later. So whatever we're seeing now in commodities, copper is slightly different, I think, but I think it's a process. It's a bottoming process as opposed to a clear buy signal yet.
Let's say one of our 40-year-old listeners has 30,000 euros of savings at the bank, which she won't need for 20 years. If she leaves the money there, it will lose half of the value in 20 years. Where would you advise she invests money right now?
As a 40-year-old, if you're a 30-year-old, I'd say invest in yourself, start a business. You'll get a higher return on your investment than anything else, whatever that business is. Because if you were to put that 30,000 euros, and let's say you want to start an artisan bakery, you can probably generate from that 30,000 euros, 30,000 euros a year. It's 100% return. People don't think like this. Yes, it requires effort.
Yeah.
So you have to factor in your time. But at 40, that's exactly the difficult age to decide, okay, what is it? Problem is there's negative return in banks, a probable negative return in the equity market,
In
in the
bonds as well.
developed equity market,
Yeah.
and bonds as well, and credit. So real estate generally will work in this environment over time, and maybe a recession is a good time to buy real estate if you've got cash. It's probably a good time to get debt if you are 40 years old, because if there's debt forgiveness coming or inflation at the end of it, debt gets eroded away. So buying a property is a good option. Or if you want to set it and forget it without managing it, then I would say emerging markets are a pretty good place to be, considering so many of them, particularly around India and all of the countries around, whether it's as north as Iran, if you want to be risky, as far across as Morocco, down to Indonesia, Malaysia. All of those countries have like average ages of 30 or less. Astonishing. So, and they have low debts, high savings, right? So that is the opposite of the world we have in the developed world. So
I presume you have ETFs in mind.
Yeah, ETFs in India or some of these countries, and I think that will do well. And if you also, I would also allocate maybe a little bit to gold. I think you will get a commodity cycle at some point, but gold is fine, that will work. And then a bit to cryptocurrency as well, because I think that's the future.
And what would you advise to those fully invested in the stock market right now?
I would suggest, if you want to remain fully invested in markets, I don't like it. I don't have it. I'm very cautious in that respect, but taking much bigger risks elsewhere. I would say, fine, just think about where you own equities. Look for those growth countries, switch, think about changing your allocation over time to those higher growth markets that have been stable, have not really gone anywhere for a long period of time. If you look at the MSCI Emerging Market Index, it's basically traded sideways in a kind of wedge pattern for the last 24 years. Now, when that breaks, these things are going to triple, quadruple. So there is an opportunity if you like that kind of thing.